Greetings, 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 greetings. You are now tuned into the vault. Trust Christian, own nothing, control everything. Just want to thank you for tuning in live, listening to replay. Always appreciate everybody that tunes in live, listens in the replay. This is Trust Christian in the Vault, episode 390, Ultra High Net Worth Investor Conference Recap 2022. A lot of people may not be familiar with the uh, UHNWI, but it does stand for Ultra High Net Worth Investors or Individual. You could put that for the I, but usually Ultra High Net Worth Investor Conference. So we're going to do a recap. We actually just did a conference for actually a few days. It was a Ultra High Net Worth Investor Conference. So we're definitely going to do a recap, go over some of the topics that were talked about over the days, give some insight into some of the different topics that were talked about. Talking about some of the thought processes. So it might be a pretty lengthy episode. Definitely might want to take some notes. Definitely going to be able to help even smaller businesses. The mentors always encouraged us to run our businesses like the peers that are good in our space, and you'll hear some recurring themes throughout this episode about different mentalities and thought process that we heard from stages over the past couple days and going over that. So we're gonna jump straight into it. One of the things that you know what's interesting is one of the first topics that were talked about during the conference was cannabis businesses. Interestingly enough, it's a so-called $100 billion industry. When you talk about, they say the retail side, not just the illicit side, but the retail side of it being 35 million retail right now coming from that industry, which is interesting because, it is challenging for these cannabis companies to do banking, which is dealing on a federal level. So that's the interesting situation that you see. The state still has such a black market, but people are operating at a high level when it comes to this type of thought process, so-called opening up a business in the cannabis industry. Whether it's a grower, what we heard from stage is taxes are really high for this business. Licenses are going to cost you. And they said just really what it comes down to is just the cost. They say the taxes are crazy and the cost of goods sold are the issues that they're having in the industry. Uh, when you see how much it costs to even grow, this stuff, and they're very particular in this space. What's interesting is they still have cannabis classified as they say one of the top levels of drugs, which are quote unquote illegal. And so this is being circulated in the culture to let these markets operate, and clearly they are. Cannabis has been this so-called the next best thing since the gold rush. It could be possibly terrifying to have such a product in the marketplace. Clearly, it's terrifying to have a product in the marketplace such as a hemp or a cannabis. Or things of that nature. So they have, or the powers that be, that the old regime of slowly letting this legislation pass through. This legislation will clearly maybe create the next greatest gold rush for the states. If they can grow it internally, it will solidify their economy even more than what it already is, because it has so much versatility to the product. So it is a very dominating product from our perspective, but even going past the dominating part of the cannabis industry, once again, 100 billion, and that's what they're talking right now. So you could see even bigger than that. So when you talk about 18 rec states and 19 medical states, you're still seeing a divide. You're still seeing the where you don't see everybody buying in yet. So They say there are a few states that are coming along. The last few that don't even have any type of legislation for it traditionally. So you're seeing things change in that space. And like we say, it's interesting that the first one of the first topics that they want to talk about clearly is cannabis, and you probably will see, a bunch of old geezers are making some money uh, through cannabis, and we know they are because they're leasing their land to these cannabis growers, and and so you see the market, where people that had land, they're in different states, whether it's California, whether it's other states where they're growing now, where farmers are just letting their land be leased by these cannabis growers. It has been happening for years now, so the farmers that used to grow wine or other products are not even looking to grow it because their markets take differently. These people that are growing this stuff, the cannabis is literally grown within less than a year. So, where it takes wine years to grow, they're not going to sit for wine for years. They're going to lease out the land to the cannabis growers and get their crop and get their money within a year. So you've seen a dynamic where the capital is being shifted clearly in this space to more of a land leasing. Once again, costs are really high for the operators, and so you're just seeing a lot of those issues in that space. But if you want to continue going down that path, have fun. Obviously, the early adopters always get beat up in any market. This is no different when you talk about, the cannabis and, the whole situation. Everybody's having to deal with lack of legislation or legislation thereof. In turn, when you get to uh, the states being divided on, is it med or is it rec, you're still seeing, quote unquote, the great divide. Maybe you're seeing and what's interesting, and listen to this, ladies and gentlemen, they actually are seeing growth trends in all age demographics. So even when you think that, oh, your doctor's not using it, or your different people that you think aren't using it, well, they were asked questions such as, where do you think value is at? Is it in the development of the product? Is it in the delivery of the product? Is it in is it in the distribution of the product through the retail centers? And literally in all areas, there is growth in all areas. Delivery, retail locations growing. So even though growing is getting beat up because of cost, everybody's getting beat up because of cost. And in that particular case, from what they're making it sound like. So there is capital being allocated there from high net worth investors. Clearly, if they have land and they're leasing it to cannabis growers as the new corn or golden crop called gold. And so these are some of the things that you're seeing in the industry where big money likes to look at right now. Big money is definitely looking at cannabis. So one of the things that we see in our space is always the acronyms. That's why we have the UHNWI on the screen, is because a lot of times you'll see these acronyms and you'll say, "Oh man, what does that mean?" And so we get to this one right here, MSO, where you're a multi-state operator of multiple businesses. And so this is the interesting thing when you start seeing what's termed as an operator of a business and operating in multiple states and seeing how they deal with the challenges of operating in multiple states. And so it's just interesting to see that they say that the industry is undercapitalized in the marijuana industry or the cannabis industry. And then when we talk about uh, taxes, they say taxes, cost of goods sold are some of the biggest inhibitors for growth in this industry right now. Uh, they were talking about even some of the fertilizer companies are making out like bandits right now. When you look back and you see some of these companies that are pretty much supplying the black market or any market in general with the fertilizers. Um, One of the things that you learn in uh, a lot of these environments is sometimes people maybe just want to be conservative in their approach. So you might see high net worth investors or ultra high net worth investors look for a conservative 10 to 12 to 13% return on capital, and they're looking for it through the EBITDA. So you hear these different terms like a EBITDA. You hear these different, once again, these are literally acronyms that they turn into a sound, but it's literally multiple words. And so when you're sitting in these environments and you say, okay, you know, I need to get a double digit EBITDA. These individuals are speaking where they want interest before, what is it? Earnings before interest, dividends, taxes, and what's the last one? Uh, Appreciation. You'll look it up. Let's see. We'll look it up real quick. Taxes and EBITDA, but it is earnings before interest, taxes, depreciation. EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. So a lot of companies, specifically in the real estate industry, they're using not only depreciation, they're using amortization. So when we see these individuals talking about, hey, we're worried about getting real estate just to literally count our downside, what are you're not even buying it for a profit. And so you would think that they're not buying it for a profit, but as we go through this episode here today, we will definitely talk about how, when you think about people saying they're willing to give up dividends to take insurance on the money, these are the things that change the investment strategy, where there are more sophisticated strategies that are being implemented. Maybe because of the structure, but at the same time, it's more possibly because they have more capital at the same time. But think about it. Even if big money is saying we're buying protection to the downside, why would any other investor not do that? So those are the things that we're talking about. So we're literally about to go over a trust system here where, some people say, oh, I don't know how to transfer property into the trust. Well, supposedly there's a follow home robbery situation going on in certain parts of the world, states, wherever, follow home robbery. And so in turn, you have to have a system that makes sure that the property that you have, whether it's at your property or not, is protected. If you have precious valuables, goods, art, vehicles, these different type of things, valuables at your house. People say, oh, you got to transfer the property to trust. How do I do that? Well, we're going to talk about it even from the follow home robbery perspective, where we have very great ideas, very sophisticated thought process towards implementing strategies of, you know, what we call taking inventory, photos of different products, or different items that you may have, creating a serial number for these products, making sure that you have receipts and invoices and appraisals taken account for when you're talking about, oh, I'm transferring property. So you take photos once again and things of that nature. Then you may send your inventory to an agent, that list to an agent. A lot of times, a lot of individuals may not have someone that they trust that can know that all of those valuables are on that sheet of paper. So you have to have obviously a trusted and valued agent. Which is fair. That may have account for the documents as well. Could be insurance documents, things of that nature. Uh, at the conference, they said some things we wouldn't necessarily completely all agree with, so we're going to skip that point. So what's interesting is this is a very critical one, is having per item limits. And per item limits means that, actually, we heard a story about a lady, possibly was married, but she literally, in their plan for security, literally had multiple safes. They had the dummy safe. They had a safe that didn't have as many great valuables in it, but it had some valuables in it. So if that ever happened, they would take them to the dummy safe, but they would have another safe that would have even more valuable possessions. So this is even more a sharing of sophisticated thought process towards, hey, if I'm going to have precious valuables or assets, I'm going to take, if I'm being held up or whatever the situation is, ladies and gentlemen, if people are dealing with these situations, you're definitely going to make it a point to have sophisticated strategies in place, such as that, where literally someone's going to go to you're going to take someone to the dummy safe in some room, and they're not going to know that there's another safe, multiple safes there, of different precious valuable assets and things of that nature. So it's per item limits. You might have a limit at this safe, and they hey, you don't know who you're dealing with, but if you take them to the dummy safe and they're gone, then and you got away with your hair on your chinny chin chin. It's always a great thing to move forward in that respect. Whereas if you take them to the biggest one, then it's all over for you. It'd be funny if you took someone to your gun safe when wait, you say, oh, the only safe I have here is a gun safe. That's what you really should say. Per item limits was a great critical key point, which is really good. And then always, which is interesting in this particular situation, was, oh, consult with an expert. And so that just means a lot of times, you want to find someone that obviously that shares your sentiment, shares your thought process of even that strategy of having multiple safes, whether they're going to be fireproof, whether they're going to be bolts to the ground, how are they going to be fitted into the rooms, things of that nature. Finding someone that can actually have a sophisticated safe in the property, and things of that nature. Man, we could really share some valuable information, man, that when you sit in these rooms, one of the things they talked about was having a proactive CPA. A lot of times, we've seen trustees come back, and most people do. This is literally 80% of the market. That's why these rooms, the ultra high net worth investor rooms, are so much more important to be in, because when you're not in these rooms, you don't even hear the public saying, "Oh, I have a proactive CPA." All they literally do is tell you that they got somebody just doing their taxes. If you agree with that point, please say yes into the chat. They don't. Most people in business in general, or even in their personal life, don't have proactive CPAs. What's interesting is that you sit in these ultra high net worth investor rooms and they talk about interest being an expense. Everybody says, "Oh, buy a house. It's an interest expense." But what about the other things that you're doing in your life as an entrepreneur? What's the interest expense in your own personal life? Oh, people say, "Get these credit cards, get these credit cards." But is it an interest expense? It's interesting, you hear the charity component come up. We didn't actually hear enough of it, but we did, because they did reserve a section for it to talk about people's charities. And I what we would need to talk about in these environments is the foundations that are bigger, that are do. But see, the thing about it is, you gotta know. Usually in these environments, these ultra high net worth investors are utilizing their charities to invest. They're utilizing these third parties to invest. They're just doing it for their charity. What was interesting is, so many people, they look at different things, but they're not familiarizing themselves with, these different type of things, where if you are going to have collectible art, jewelry, pearls, gold, diamond, antique cars, there is an antique tax. You have to be aware of these different things. For all the trustees out there, you're going to start hearing more and more about first trustee funds, because a lot of people are not familiar with first trustee funds. When you really get a chance to look at it, a lot of times most people are in a position of trying to grow their family wealth, where first trustee funds is, you're definitely going to be a little unbiased in your approach. You're going to be making maybe possibly a high level of conservativeness in your approach. But even sitting in a room, we hear a 66% return. Those are people calculating their downside and their upside, buying high levels of insurance, and these are the things that you're going to see. You're going to see, ultra high net worth investors almost are spending money just because they're losing money. And even still to this day, remember when we first got into the wealth management information, th- people, your money is losing its value, whether that is per inflation. The money is losing value per inflation. So even though you're making more, or it's losing its value, even the fact that people know that it's losing its value, people are betting for it to lose its value. So, bam, that's your insurance to the downside. And so we see that this thought process is being perpetrated throughout the ultra high net worth investor thought process. It looks like, sounds like, and looks like it's been going on for years. Especially if you know inflation is whether it's at a high moment now or at a low moment later, it's still showing you that there's a depreciation in the value of a particular asset because it's taking more of that asset now to actually get the same type of result with previous years known. So historically, that is what's being looked at specifically by some of these first trustee funds. They're looking to almost pay to their downside as much as they're looking for an upside. What's interesting is everybody wants to talk about real estate. Oh, real estate, real estate. We heard quite a bit about real estate this past few days, and what we know about the real estate is a lot of the people were asking questions about operators that literally just own property in general, specifically multi-units, strip malls, things of that nature. What you understand, sophisticated real estate investing, they're investing in what's called essential businesses or essential properties. Essential properties were properties that had a medical facility on it. Essential properties are that had grocery stores on it. To hear these operators, literally, let's just say you see a fund. Literally, we have a fund that may be operating, let's just say $500 million in assets or $1 billion plus, but we'll just say 500 minimum. They literally have properties all over the states. They're a multi-state operator, literally because they had a grocery store in their strip mall, because they still had a Domino's in their strip mall, because they had fast food chains, restaurants in their strip mall. These operators still were able to literally go through the entire pandemic from 2020 to 2021, 2022, and still be in a great position. That was what we call essential properties. So when you hear the sophistication of the strategic positioning of their dollars that are losing value, that they already know, this is the way that they're thinking. Their dollars are losing value. As an ultra high net worth investor, I need to put these dollars into essential businesses, essential properties, things that were considered to be essential during that time. So that part of the portfolio is pretty much never going to change. Sure, we can swap out restaurants, but fast food restaurants, but to have an essential position in property was really, really good to see. To even have that talked about was really good. Uh, the biggest thing a lot of ultra high net worth investors are looking for, but the new buzzword nowadays in the public markets is cash flow, based off Robert Kiyosaki. Oh, cash flow, cash flow. Literally, when you're sitting in a room and you're hearing, you know, investors talk about assets versus basis points, BPS, what do you say? You say, oh, we're not talking about cash flow here. No, they're talking about how many basis points is going up or how many is going down. Once again, if we're looking for a conservative double digit returns, those things change the thought process of the way that you're looking for returns. We got into real estate was talking about adaptive reuse properties. So not just essential properties, but adaptive reuse properties. These are terms that you have to look up and put in your real estate conversation, because there are so many properties that you literally can go in and take a property that may be an old manufacturing building or old office building, and going in and just literally adapting and reusing the property for something that would be similar but just more updated towards where the trend is, whether it's companies wanting to have people back in the offices and having them in bigger spaces. See, these are the things that they wanted people to fool people with in the public, which is, oh, well, people aren't going to go back and work in these office buildings. What are you talking about? The companies are buying more office space now because they people just want to be in the office. They want their people to be in the office, but they're willing to spread them out. So we're not actually seeing a downturn and companies coming back into these spaces, they're actually still equaling the same amount of space, or possibly just a, even if it's a, what they say, 2 to 3 or 4 basis point higher, just based off of the fact that they're getting, higher yield now because people want more space to spread their people out. This is the difference in thought process when we talk about, how real estate is being acquired by ultra high net worth investors, and where they're looking to, uh, put their capital, and things of that nature. They were looking for neighborhood anchor grocery stores. Those were those properties that they had, that when you see the holdings, when people say, well, where are you putting your money at? This is where the money's going. They're looking for adaptive reuse properties. They're looking for, neighborhood anchor grocery store properties that, so it's like, oh man, well, how do I get that level of capital? The biggest thing is finding a deal. They have the capital. See how they will give you the money for that project if you find that project. So the issue is how do you obviously scale that venture, uh, when you're talking about going out and getting those properties, how much time it takes, how much work it takes, things of that nature. We're going to do definitely quite a few episodes. And this is once again where we go back to where people see, which is interesting, is to see a lot of young people aren't too swift when it comes to how to build wealth, because they didn't tell you in school how to, when you get the money, how to invest it. What they said was the old regime, baby boomers, they had the company investing in via 401k or some IRA. So younger people don't have that level of like, hey, I'm going to walk into the office at my job and talk to them about a 401k or some pension. That was outsourcing the pension anyways. Younger people are having to learn that they have to insource their pension. Well, how you insource your pension, what the old fogies did, the old fogies would say, well, hey, we're going to give it to the company and they're going to invest it into the stock market. And this is what they invested in. It's called a long only pension fund. So that means they're long Tesla. That means they're long Microsoft. That means they're long Uber. They're long these companies. That means that they're in these companies for the next 10 to 20 years. Why? Because they're possibly waiting for a dividend that they can live off. So they possibly could, they're going to see the stock go up, from $300 to $10,000, or $300 to $700, or this is, or from $30 to $100. That's a good margin rate there, from $30 to $100. So if you had a bunch of those stocks, you would see, oh wow, over 5 to 10 years, we would have a long-term pension fund. So when it's time for us to sell when it's high, hopefully we're not the dummy that sells when it goes up and comes back down, because that happens to many people in the stock market. But we're going to say, hey, let's stay in this. It's called a long only pension fund. Y'all can do the research. People can do the research. Called a long only pension fund. That's what the baby boomers, some of the Generation Xers have pretty much put their money into. They're working for the UPSs of the world. They're working for these union-based companies right now. That's what they're doing. They're working for union companies. That's what they're doing. So the young people say, okay, well, Uber doesn't have a pension. Amazon doesn't have a pension unless you work for their real company where you're labeled an employee. And who knows if they have that. You can do your research, but we're talking about how, okay, younger people understand. Equities used to be an inflation hedge, and it still is an inflation hedge. That means we're going to take the money from our jobs and we're going to invest it in the stock market. That's equities. So since we're going to invest in equities for the long term, that means at one point in the future, we'll be able to draw down from this account. We'll be able to pull money out of this account. And this money would have grown exponentially based off compound interest and various other factors. So by the time we reach the age of retirement, we have money that'll keep up with the so-called rate of the depreciation of the money that we're using. It's called an inflation hedge. So younger people have to get very savvy very quickly at the fact that, yes, if you don't know stocks, which if you're going through these third party companies, oh wow, I'm going to go through Robinhood, and we're not endorsing any companies. This is not financial advice. It's not legal advice, but we're just having a general conversation about what's going on here. So let's talk about No, you're going to say, okay, I'm going to put my money in the market and I'm going to get these companies. Are you long only in your thought process? Did the old timers get you too? In their thought process? Oh, I'm going to put my money in here and just think that it's going to go straight up. Really? It's going to go straight up, huh? Nah, that's not how it works. And so when we say that it goes from you're in zero, it goes to 100, it goes to 200, right? And then it loses 100. Where are you at? You're down. You're not up, you're down. And so when people say, "Oh, well, it doesn't just go straight up and it doesn't go straight down," that's right, because it's an inflation hedge. Inflation doesn't so-called just go straight. It's not always high and it's not always low. It goes up and down. And this is the thought process that younger investors have to get very swift and savvy about as they move forward in their investment strategy, because ultra high net worth investors are thinking about this from the beginning. This is why they're in equity. This is why they learn equities. That's why they learn stocks, because it's an inflation hedge. We were sitting in a room, and a lot of times, a lot of people say, "Oh, well, what is who are they giving the money to? Who are these private investors giving money to? Who are these ultra high net worth investors giving money to?" That's always going to be the question. But what's interesting is we're going to share with you the simple answers that they gave from stage. They're looking for a decisive person. Out of all the traits that you can have in your personality, they're looking for a decisive person. It's very interesting to see that that is what is one of the top things that they're looking for, because you can look at your life as a microcosm of your decision making. They were looking for someone with track record. Second thing is they're looking for you to have a track record of success. They're going to ask you, what have you done in your life successfully so far? How is that an abrupt question? You're going to hear that in an interview when you're asking somebody for more than $5. What's your track record in this? Have you built something from scratch before? Have you assembled a team before? You think they need to ask that question, or you're going to answer that question with confidence and you're going to thoroughly explain how you had to build something? Because they want their money back. Of course, a private investor wants their money back. But this is the issue that we see in the marketplace with a lot of these operators. And we got to go ahead and talk about what the difference is, because this is the confusion in the marketplace with, we're going to just say, people that are not educated in this particular environment but want to get capital out of this particular environment. It's almost like asking yourself, well, why can't I go in the room and get the capital? That's fair. We're going to answer that question, because an individual may come in, or a group, a team, whatever, may come into this environment, private equity, private investing, and they are not a pitcher. They're not they're not a CEO. They're a founder. Usually the founders are going to be maybe your pitchers. Sometimes they're not. Usually people that are selling their ideas in the private markets have sales teams that are selling their ideas to these particular private equity companies, because or VCs or whoever, angels, whoever, because you got to know your role. And so what we see is one man trying to do it all, one woman trying to do it all in their particular business. And this is where you have to assemble a team where you have a CEO that's different from the founder. Why? Because what happens is people conflate these terms and think that they are a founder when really they're the CEO. Or they think they're the CEO, but really they're the founder. And what are the other roles of the company? Do you have a secretary? Do you have a treasurer for the company? I mean, these are very critical people in the company. Do you have a vice president? Do you have a president? I mean, these are multiple different roles inside of a company that has to be you put in place in order for these companies to take you serious as a company, instead of it just being Rashad, Meshach, and Abednego in the fire by yourselves. So we see a lot of times private money is looking at these deals, people that are bringing them deals, and they're not in a position where they have a team. They're not in a position where when somebody asks you who you are or what you do, you're the CEO, or you're not the CEO. Are you the chief executive officer? You're making executive what? Decisions. You don't need to be the founder then. But most of the time, a lot of these people, they are the founders of these companies. And by you being the founder, you got to find a CEO, chief executive operator, chief executive, or you can find, here we go. See, in trust, this is what we do. We go find a senior chairman. You can go find a senior chairman. You're putting together a board, you can find a senior chairman. But a lot of times, a lot of people, they ain't humble themselves. You want to know why you get money? It's because you got other people that are more successful on your team, more people in your corner that are successful. That's why you got to associate with more people that are more successful than you, because it puts you in a different space. And that's the difference. People want to be, what are you, the owner or the operator? Because those are, do you know the difference? The operator is actually the manager of the company. You could be the chief managing officer. You got to be decisive in the management of the company. Are you at the start phase? Are you at the management phase? Or are you at the exit phase? These are the conversations that are being had in these environments because they want to know your strategy. When you come in, do you have a strategy for your business, for your idea, for your deal? Going back to our point of the expense of interest is the cost of capital. The expense of interest is the cost of capital. Interest equals cost of capital, ladies and gentlemen. When you have to pay interest, it's an opportunity cost loss. Do you hear that? But how many people think about that? Think about their downside. And what's interesting is we'll give out this term straight from the vault, first on the internet, for sure, for sure. ROI standing for risk, opportunity, and income. You got to be able to see the risk that an opportunity is going to present. And this is what they're looking at first when they're looking at the ROI. They're looking at the risk of the opportunity and income from it. We've heard some. What's interesting is a lot of times when you're in these environments, you hear these thought processes of, oh, how do we attract more investors? How do we attract more investors? Because we're talking about it from both perspectives in this episode. We're talking about it from a perspective of, oh, I'm looking to invest, and then as well someone else saying, hey, I have a deal I'm looking to sell. And so what you hear is a lot of times is a lot of people may be sitting on the sidelines not deploying capital. We've heard this for years. It's more money than deals. You're right about that. It's more money than good deals for sure. And so we're talking about that in this particular episode because it's important. It's good to know, it's good to go over. So when you're sitting in front of investors that are waiting, you're going to ask them, at what point would you be willing to get in the market? These are the things that we're asking our investors right now because there are opportunities in even so-called rising inflationary rates. And this is why it's so good to be around people with so much capital and ultra high net worth investor environments, is because they really are opportunistic. They're not too conservative in their approach where they're not willing to take risk at any given moment. And to be able to look at things with a very market neutral lens is very refreshing when you're in these environments, because a lot of times you don't see people nowadays really opportunistic, quote unquote, or optimistic, quote unquote, in these environments. Not necessarily ultra high net worth investor environments, but investor environments where the sentiment could be okay. We're always talking about our downside, and okay, yeah, we are going to talk about our downside, but to hear, still the optimistic thought process towards, let's take some type of approach as opposed to not taking an approach at all, when we are aware that the capital that we currently have is literally depreciating. And so that is a very interesting thought process when it comes to moving forward, is, having a defined investment plan. These are things where it says we're not sitting on the sideline. It means that we possibly may have an aggressive approach right now, or some type of moderate approach or conservative approach. And those are the questions that you may be asked, is what level of investment would you like to make? Would you like for it to be an aggressive or a conservative or a moderate? You know, and so we got quite a bit of value out of the Ultra High Net Worth Investor Conference, because it just was a critical event to really see what they're looking at. When they're looking at companies that they're looking to buy, you got to have a healthy balance sheet. You have to have good margin controls. Um, you have to have a spread in your company that looks worthy of even purchasing. So when you look at your company, you say, what do I need for my company to be something that I can sell to, people? Well, this is it. You got to have a healthy balance sheet. You got to be able to control your margins. You have to be able to control your spread, or be able to at least to have a spread when you're looking for return on capital once again. So definitely really happy with the conference and what we got out of it. Uh, you know, what's interesting is, even in the real estate, going back to the real estate, because that obviously is going to be where a lot of people say they hold money, and particularly in an equitable position. But when you really hear it, what's interesting is you don't hear them really say you should be in it. It's just a lot of times they're in it because it's a great place to be. But when you see the high level of aggressiveness towards diversification in other asset classes, you see once again that they're not just looking to say, okay, we're going to own. What we're talking about now, which is build to rent, which is literally still seeing a boom, quote unquote. Even with the housing starts this past month of what was that, May 2020, literally May 2020, they literally had one of the housing starts were up. So to see the build to rent, where they're building single family homes now to rent in communities, and they're having success, I think that definitely is a great place to look. When you talk about even yourself as a developer, you're going to see quite a bit of wealth grow in that area, or in this particular case where they're just going to maintain it. And so they understand these growth areas, which is more build to rent instead of build to own. You don't want to, you're going to see more people not want to own it, but they do want to rent it with minimal liabilities, and that is a great. It's interesting to see the strategy actually, particularly in actual hard tangible depreciation. And you think about it, that's really what it is when you talk about hard tangible depreciation. That's literally what it is. You're in real estate, clearly there's a depreciation that goes along with it, and now they're talking about building properties that are single family homes that are just where people are going to rent them out. Like this is even more interesting, and it's not a bad trend. We can see it as a solid trend. Definitely don't knock the trend. It's definitely there, and you're going to see you're seeing it grow. It's worthy of continuously looking at for at least the next, whether you're, even if you want to talk out, 5 years, sure. But even and what's interesting is to even hear the mindset of the ultra high net worth investor environment talk about how that real estate's changing, is very dynamic, and it's hard to put your hand on. To hear the level of the level of discernment towards the industry of, it's not easy to just quote unquote go and make money over the long term. And that's what they're looking for. They're looking for those obviously, 5-year projects, 10-year projects, but particularly in our environment, we saw multiple angles from it where they're looking to invest in the project, build it within a year, and get out of it and get their cash back by selling it off to someone. So to even see developers come in, have the capital to build the project out, and then exactly a year later or two, no more than three, sell the project within 3 years of building some type of building, some type of infrastructure, some type of community, and things of that nature. Selling it off is interesting in and of itself, or selling it to, you know, the developer, selling it to other parties, and getting that capital from them as well. So uh, one of the things we always go back to is just having a defined outcome when it comes to investing in life. These are some of the thought processes that can get drop ball in life, because if you went through public school, you just sat there and you're like, oh, what am I doing all day? I'm learning algebra. I'm learning how to go to the moon like Elon Musk, but I'm probably never really wanting to go because it doesn't look too safe yet. It's just like, okay, like you're learning things that you would consider to be a little unnecessary. So when you do get out of school, no matter what level of school, quote unquote, it's an imperative thought process to say, okay, I'm going to have a defined outcome. And these are the thought processes that you see in these high level of thought processes. You're not managing hundreds of millions of dollars, or any type of large level of capital, and not being sophisticated in your thought process. You have to be sophisticated in your thought process. That means, yes, you are going to have that term in your vocabulary, that you have defined outcomes, whether they're in life or whether they're in investing, and in particular investing, because it is so many levels of ambiguity that you kind of have to have a plan when you're walking into it, which is very, very important. So, very important. We got some really good trade ideas out of that room, and it's crazy because the organization that put it on, they literally are a registered investment advisor. But the thing about it is that they actually are they get their hands dirty. They're a full encompassing thing. They got the sole prop traders behind closed doors. So when you see that they're able to talk that language and give a plethora of content on various different topics, it really shows you how serious it can get. How serious it can get. That these gentlemen, or ladies and gentlemen, where they're speaking the various languages of wealth management, not just one, not just coming at it from a legal perspective, not just coming at it from the financial perspective, but coming at it from the macro level, coming at it from the micro level, coming at it from the trend level, coming at it from the thematic level, coming at it from a perspective where they can actually let you know straight from stage, these are the trades that we put in. That's rare that you hear that, because it wasn't that they gave a particular trade, but they did let you know that they are buying insurance. They are buying insurance for the capital that they already have, because they have hundreds of millions of dollars, billions of dollars. Because so when you see this level of thought process, that hey, we have large levels of capital, buying insurance, or to the downside in trades, it's like saying, well, why are you selling? It's like, well, why are you buying a put? They were really talking about this, and it's really important to know that it's this way in a life, but to hear it from the investment conference, it shows you how you shape your family off of solid principles. Where the investment thought process is, you have to be intentional instead of responding. So many people in their investment thought process in their lives, they're responding instead of being intentional. And this is very, very important for you to just continuously make it a point to develop your thought process, to intentionally program yourself. That is the point. You got to be intentional in your wealth building process. You think you're going to get wealthy because you're going to the barbecue? It's about to be summertime. You think you're going to get wealthy? You got a defined plan for your summer, right? We're going on this vacation, we're going on that vacation. But how many did you have a quarterly income growth goal in your investment lifestyle? It's intentional. You think you're going to retirement financial freedom because you're an American? That's welfare. People have talked about Social Security going under for years now. And if you're a millennial and you think that it's going to be here for you or anybody younger, you're lying to yourself. Why? Because the old people have already told you we're milking the system. It's over, but we're still going to make you pay into it right now because that's the way it's set up. But you millennials, you're not having kids. You're having one. You're supposed to have two. Why? Because if you only have one, you have the generation below you. And because you have the generation below you, guess what? You're going to have half the money that you provided for your parents. Makes sense, right? Right. But are you being intentional in your investment thought process? Knowing that your parents had pensions, knowing that your parents had 401ks, knowing that they had IRAs, these so-called, what they call them, government sponsored programs. You hear that? Sounds close to welfare again, right? But this is what the people maybe want to deny. Oh man, I don't know. They didn't give me the great education in public school. I went to college and I was underwater in that too. So what am I gonna do? Am I gonna give my money to these banks? I don't want to give it to the bank. Here we go. We're gonna go into the crypto BS because we're still here with it. We're 10 years into the crypto. Are you buying your socks and underwear with crypto? Oh yeah, there's so many investors. They're investing in crypto and they're making all of this money and they're buying their underwear and socks with the crypto. Sure they are. When we're sitting in the room with the high net worth investors and they got it in a what? IRA. Why do they have an IRA for something that's not supposed to be government regulated? Does this make any type of sense? You want to know what investors that have hundreds of millions of dollars walked out the room saying? And I still don't know what it is. Hundreds of millions of dollars, billions of dollars, and I still don't know what it is. But you'll get people sit on stage, tell you this is about a smart contract. Guess what? This is pre-internet. Oh, it's a disruptive technology. Wasn't the internet a disruptive technology? Didn't it take money away from traditional media and other forms of business? Yes, it did. Didn't streaming disrupt what was the traditional consumption of video screen watching? Yes. So here we are again. Are you being intentional in your thought process towards your wealth building? Seeing these different opportunities in the marketplace. Are you seeing these things happen in front of you? Oh, but the Bitcoin, it's got all of this plus and all of this. We're going to get back to this document here. We're going to see. Maybe at one point we'll talk about Bitcoin right now. We'll talk about this so-called crypto thing and what the billionaires think. We did an episode about that daggone Bitcoin and what the billionaires think of it. Because once again, we got multimillionaires. You think these people are about to give up living in the Hamptons for a Bitcoin tchotchke? Oh yeah, here you go. This is what the ultra high net worth investors say. The ultra high net worth investors say, hey, let's only give 1% towards that. Sure. What do you say? Allocate a small portion of your portfolio to that. Sure, 1%. Financial security was something that we see as a big priority for the millennials. They really do care about financial security. And they're doing whatever it takes right now. They're very aggressive in utilizing these online platforms. They're familiar with the fact that they saw their parents not be able to utilize the internet to make money. The millennials are going to do their best to capitalize off of this opportunity. The younger generation Z, they're already, so-called overnight successes on these social platforms. The algorithm is feeding these people into what would be considered celebrityism, metaverseism. They're going into the metaverse making money now. These people are having, these major retailers give money to these so-called influencers. You're an influencer because you're getting capital from a Fortune 500 company. Sure, they're going to put a Coca-Cola machine in the metaverse. Sure, they're going to put a Pepsi machine in the metaverse. Sure, they're going to put a Nike retailer in the metaverse. So we were thinking about this. Let's go into this metaverse BS. Okay, so you're going to buy wine. First of all, wine is
is an antique, ladies and gentlemen. This is a powerful thing here. This is like any antique on the planet. It's collectible. So when you have wine from a specific year, specific crop, a specific vineyard, we're just using this as an asset. What are you going to do? Tokenize it and sell it on the internet? Put it in the metaverse? Once you put it in the metaverse, now somebody in the world can buy that and you'll so called get metaverse royalties from this. But who really has the value? Is it in the fact that it's in the metaverse, or is it the fact that you have that tangible piece of wine that literally, if you open it up, it changes everything? If you break it, it's everything. I mean, these are critical elements to what you even have as a perceived value of this silly token that's on a damn internet. And that's the issue. If you see value in that, you're going to make a killing. But I promise you, the value is in that wine, that hard, tangible asset of wine. That if you open it up, you change the chemical dynamic of that wine. And that wine by private investors will always be paid for more with true tangible dollars because it's the real thing, not the so-called imaginary thing or the virtual reality thing or the augmented reality thing, some goddamn Pokemon in real life thing. It's not that. We're going to discern what's an asset and what's a liability. Oh, you're going to make all of this money with the token and selling that wine over the internet because people want that in their house, on their metaverse house. We're not denying that video game mentality. But that's fantasy football. That's fantasy football. That's fantasy sport betting. Do you want to address this negative sentiment that, whether you know it or not, ultra high net worth investors don't really care about? And this is how you know the level that you're talking to. Ultra high net worth investors aren't trying to save anybody. And that's okay. But when you walk into the world with an entitlement mentality, they know it. And they're buying insurance to the downside. See, people that have this entitlement mentality, whether you're the younger generation or older generation, you're going to perish. The system in the States, it's not made for entitlements. It's made for you to create. It's made for you to get off your rusty dusty. Because if you have an entitlement mentality, you have a non-incentive based system. In this system of the United States, they have a system that says if you do something, you have a chance of winning. If you don't, you have a chance of living at the below average poverty level, whatever level they want to call it, what welfare level, whatever level they want to call it. So when you look at the ultra high net worth investors, you got to follow suit. You got to follow thought process. You think they have an entitlement mentality? You think people in these environments that are, we'll be honest with you. We sat at the table with two second generationers. That's how you know it runs deep. We got companies sitting on stage that say they've been around since the 1700s. 7 generations deep. 7 generations? How do you get 7 generations deep? They're in private banking. You know how many private banks we heard from this week? People say, oh, I don't know how to get the money from the private bank. I'm only going into the public bank. I'm going into the big commercial banks. Why am I not getting money? Because you don't know about the private banks. You don't know about how the private banks invest. You don't know their investment strategy. The public banks have an investment strategy, but do you know the private banks' investment strategy? But let's get back to this entitlement mentality that the so-called younger generations have. Because the so-called older generations, they try to say, oh, well, we have a thought process that we're going to work hard and pull it up from our bootstraps. Well, who created Social Security? Did you hear that? Olders? You know? You created Social Security. New Deal. You know? Great Depression. Uh, you know, stock market crashes. You created insurance for your downside. What was that? You're going to get older. Many of you didn't create a business. The public school didn't teach it. But now we're going to go to the youngers, the youngins, where you see, okay, there's a great divide that's happening because the system is based off of work hard, play hard. Too many people are playing while they're trying to work instead of just working and then playing. And that's what the old fogies thought. They said, we're going to work hard and then we're going to play hard in our 60s, in our 70s, and in our 80s. We're going to own a football team up until our 80s or 90s. Do you hear that? They're owning football teams up until their 80s or 90s, passing it along to the next generation. You're going to see second gens hold on to some of these sports teams. Some of these sports teams get sold off because the family might not have their estate in order. So you see various levels of that. An entitlement mentality. You think the government's supposed to pay off your student loans? Entitlement mentality. Is it in the society? Sure it is. Of course it is. It's in the society. What do you mean? They think the government owes them something. The government doesn't owe you nothing. And the faster you realize that, or the faster you think about this, and the faster this strategy is implemented, there is no need to save the country. What do you mean? You're saving it from yourselves. You don't want to pay into Social Security anymore? Stop utilizing the system. Create. Social Security is for employees. You think an entrepreneur investor needs Social Security? Do you think they took a stimulus check? You think that ultra high net worth investors or entrepreneurs, you think your your favorite rapper's rapper took a stimulus check? How can they take a stimulus check when they're wearing a chain that's $30,000 or $100,000 around their neck? They were making more than the average person makes in a year during that pandemic. They could have sold a chain. They didn't. They didn't. When you go listen to their songs during the pandemic, since they're talking about the culture, they're literally saying that they made more money in the pandemic through streaming and the internet, selling albums. Everybody wanted to drop an album. These are the so-called businesses that are booming, right? Right. We didn't see any rappers in the room. We didn't see them in the room. Why? For a reason. It's about making it look good, right? Gotta make it look good. Entitlement mentality. Oh man, we know that the rappers didn't get the checks, but their consumers did. Okay. What about the entrepreneurs that created the grocery store? That you can go create a grocery store in your local neighborhood. What about the gas stations? The owners from other countries that own the gas stations. Well, maybe getting your nails and your feet done wasn't that much of a priority because you weren't going out, but people were still getting their nails and feet done. People were still getting their hair done as women. Maybe not as much, but they were doing it. Essential businesses once again. They didn't take checks. How could they take a check? They were the owner of the shop that was making money because they got in what would be considered those recession-proof businesses, not buying into the myth of, oh, if you want to be, well, network marketing has created more millionaires than any other industry outside of real estate. Yeah, right. Entitlement mentality. What happens when you do go down as an entrepreneur, when you have to suck a little bit of gas real quick? What do? Suck a little exhaust fumes out of your car. What do? Did you hunker down? Did you sell off any assets that you had? You think about that. These major Fortune 500s are sitting on cash and they're sitting on assets. They can sell off their technology. You think Elon Musk couldn't sell the technology right now for Tesla to Ford? They're not going to let it happen in the government because then Ford would be a dominant EV player immediately. You see how that goes? But they're sitting on an asset. They're sitting on hard, tangible assets, and that's all they're sitting on. They're really not even sitting on a cash flow. Because when you go look at their balance sheet, how much money? Everybody doesn't have one of those cars. They're not the only player. And guess what? Did they sell more cars last year, volume-wise, than Ford? No, they didn't. Did they sell more volume last year than GM? No, they didn't. We're going to move on. Don't have entitlement mentality. Entitlement mentality, we've seen it in the marketplace. People talk about saving America, getting America right, making sure we're going to go in that direction. Well, that means that there's no entitlement mentality. And the people that are pushing this, permeating this thought process of some entitlement, is we know what position they're looking to come at you from. And this is the difference between a meritocracy versus equality. And you're going to continue to hear these conversations come up where people say, oh, we don't need meritocracy where you earn it from your bootstraps. We need equality. Oh, we want everybody to be equal. Well, guess what? Equality equals an entitlement. Because we're even in the Constitution, it says that we're created equal for opportunity. Not just the, oh, well, what are you saying? We're all going to have the same income? No. So there is no income equality. Do you hear this type of conversation that's seeping into the conversation? And that's the issue. Is that people of the older generation for sure don't believe in that. And the people of the millennial generation are will look like, well, we've seen people have to earn it. We've seen people go from zero to hero, and we're okay with that. But the younger generation, are they being pushed? The even younger generation, are they being pushed? Oh, well, there needs to be an income equality. Yeah, income equal for everybody. What do you mean, everybody? Does everybody have the same religion? No, then everybody's not going to have the same income. That's how you know we're not equal. It's that simple. That's hard to hear. Talking about some daggone income equality. Give me a break. And when they push this stuff on you, you got to reject it. When you sit in front of these politicians, you got to call them out. You think this is a game. These people are trying to put you in some goddamn terms that we don't even care to say on this platform. And y'all think this is funny. And you think it's okay to let people talk like this to you. Income equality. You got to call these people out and get them off a stage. You got to stand up for the right to have the opportunity. When you ask people from the environment that we were in, at the ultra high net worth investor environment, what does America stand for? It stands for opportunity and freedom. Instead, you got people sitting around talking about some damn income equality. The ultra high net worth investors, it's not that they don't want to invest in anyone. They're not going to invest in an idiot. And people think it's okay to say we're all created equal. We need to be equal in that respect. Well, what happens when you see the lack of distribution of capital to particular groups? We got to group it because we're still doing statistics, right? We're doing statistics, so let's talk about it in the groups then. And why is it that certain groups don't get capital and other groups do? We could sit in a room and tell you right now, 60%, here we go, we'll be conservative. 40% of the room was Jewish. You think it's a coincidence that this one population, once again, is able to sit in a room and dominate in finance? We could go anywhere. Maybe it's reasons why that room was set up the way it was. But nevertheless, when they asked the question, just that question alone, 60 at least, a minimum 30, for sure. It was a guaranteed 30, but for sure pushing 40 plus, 50 plus of the room was Jewish on one particular day. I mean, do you hear the thought process behind a culture, a group of people focusing on wealth, focusing on capital, preservation? Focused on meritocracy, being the best. Family businesses is private. We're going to do an episode about this. Somebody asked that question. How's a family business private? It's interesting because we saw this so-called expert sit on stage and say that a lot of these politicians don't really know what private wealth looks like. They supposedly don't know because these politicians supposedly don't come from money. Supposedly, that's not true. These politicians supposedly don't come from money. That's a lie. Supposedly, these politicians don't have any money before they're a politician. That's a lie. Not all of them, whether they try to brand it or not. So supposedly these politicians don't know that Family business is private. They try to act like they don't know. So supposedly, this expert is an advocate for private businesses to get their voice heard in Washington. Really, really. They want them to tell their stories. You think someone in a private business, they're creating they have a farm. Supposedly, and it's not supposedly, it's one of those things where you do see a lot of private families have large holdings. Why aren't they out and advocating for businesses, private businesses in the public? Because they're private, one. Did you hear that? Always stick to the principles. They're private, one. And going to DC is a conflict of interest. Whether you want to know corporations run America, what's wrong with that? But to ask somebody to come from the private and talk about what in the public? Advocate for businesses. Advocate for businesses instead of advocating for entitlements. The system isn't broken, but the system isn't perfect. But the system isn't broken. Because when you sit in our environment, the ultra high net worth investor environment, when they're telling you they're buying real estate for a tax write off, what are you talking about? They're not buying it to own it as a home. They're buying it as a tax write off. What are you talking about? There's no opportunities to minimize your liabilities. There's no opportunities to get wealthy. It's not about how much you make, it's about how much you keep. But if it's about how much you keep, then why are they buying real estate for the tax write off? Because they're paying for insurance to the downside. They're paying for insurance to the downside. We're just going to buy real estate as a depreciation mechanism, as a tax write off. That's not entitlement mentality. That's not give me a handout mentality. That's not pay off my student loan mentality. They're trying to get private people to come out in the public and show their face. What are you talking about? You think they want to be known? You think they want to be bothered with people asking them for money because you supposedly have more money than you can ever spend in your life? And what are they going to say in DC? We're going to create less programs for less need of us. No. They're going to ask for more money via taxes so they can stay in office and do some good with it, right? Right. Entitlement mentality. It starts at the top. It starts at the leadership. Is the leadership of the country of America serving the people? This is what we don't hear because they don't want to talk about it. The facts is, are you serving the people or are the people serving you? So-called leader. They're not leaders. They're administrators of a document, the Constitution and our current legislation. They're administrators. They're not even interpreters of the law. They're administrators of the law. Interestingly enough, when they tried to kill one of the most trusted businesses in America, you will see mom and pop restaurants pop back up. Fast food restaurants held it down. In the States and around the world, the mom and pop restaurants. This is why, if you're smart, you go and you send your kid or you go to get five-star chef capabilities and you go back to your local neighborhood and provide prestigious, high-end, quality food to people because your margins are going to be the fact that you're already luxury and the fact that it's a specialty product. So what you do make, it should be successful. A lot of people say, "Oh, would you go into a restaurant?" Man, all throughout my 20s, I would have never did a restaurant. And even still to this day, I still wouldn't do a restaurant. But if there's someone that has five-star Michelin skills and they have a name, once again, if we're in the social media age, they have a social media following and they want to be funded to open up a restaurant because their name is big and they're going to build that platform out through a quality marketing program, you could see that restaurant literally jamming out millions of dollars a month. And those things are critical when you're talking about having high-end destination restaurants that are trusted by many people. we're actually starting to see in some, and this is an early trend, uh, you're starting to see a lot of trend towards try before you buy. And it's interesting. You're going to see that try before you buy thought process. What do they call it? TBYB. Try it before you buy it thought process. And what's interesting is when you see this try before you thought process, try before you buy thought process, it's going to start happening more and more across the marketplace. You're just going to continue to see it. You know, with most of your product lines, you're not just going to see freemium anymore. You're going to see try before you buy, which is really, really interesting because, you know, back in the day, companies would say give you a trial period. Remember, they used to give you a free trial period. That's going to permeate more and more businesses nowadays where maybe you try it at home through your visual oculus before you go to the store. You know, in many different sectors, you're going to see that happen where you utilize these technological tools, you know, whether they're VR glasses, AR glasses, where you're going to be able to go into an environment, look into an environment, be in an environment, and you don't have to physically be there first, but you will be able to get a feel for that environment, get an idea if this is something that you want to engage in long term, and then bam, they actually when you pay, they know they got a loyal customer because you actually have taken a commitment of getting in bed with this company and going longer. So you're starting to see people just go more to a try before you buy model, which you got to kind of look at that for your own business. That's a very high level, scalable thought process when you talk about try before you buy thought process. You think about if you can implement that strategy in your model, depending on what business it is, I mean, you could see great dividends come from that. Um, so when we talk about the vault and the value that we provide at the vault, we always talk about like communication skills. Uh, we always talk about like communication and leadership. And sometimes, you know, you got to hear so many other people's perspective. A lot of times, a lot of people may not want to hear people's perspective because it may not agree with their own. You know, even when they were talking about Washington, why don't people make these changes in the room? And they said partially because these politicians are egotistical and they think that they're the smartest person in the room. And it's like, well, if you're a president of a country, you're probably going to think that you're the smartest person in the room. If you're just a high level person, you're going to probably think you're smarter than a lot of people. And so ego comes with these positions sometimes. And so being in an environment where you're able to listen to your leadership is critical. Having a superior leadership team is critical. Selecting that team is critical. And so being open to hearing multiple perspectives is a big deal. You know, one of the things we heard even at the conference once again is, you know, telling is yelling. You know, sometimes when you're in an environment with a family, you know, or you're looking to go through some type of educational conversation or some type of family gathering conversation, you know, telling people things is yelling, you know. So it's kind of challenging to be in these environments where there are generational gaps and generations are used to telling people things as opposed to, you know, asking, you know. So it's one of those things that, you know, the younger generation, where you hear them say, you're yelling at me, you're being loud, is because you're telling them, you know. So it goes back to that sharing is caring line, you know. As a leader, you have to share. And that's what this platform provides, is thought leadership towards ultra high net worth investor, you know, investments and thought process and things of that nature. Um, we're gonna definitely do a misinformation dissemination episode because when we hear these people sometimes even from stage, it's like you gotta be able to know that people are gonna check your facts. And that's the issue with these people nowadays, and the younger generation is just going to timestamp everything. They're going to create a conversation in chapters. And what that means is that they're literally going to take your speech in any environment and they're going to fact check everything that you say out of your mouth. And each point that's going to be sourced to different bibliographies of information that you're sourcing, because even in these environments still to this day there's so much misinformation that's being disseminated because people are just able to say these things, and no one's able to fact check them through some type of real-time AI and track what they're saying and pop up on the screen next to them and say this is bullshit, because that we have other statistical environments that share that this is not completely accurate. You're a little off in your numbers, and it's very important when you're spewing out numbers, especially when you're talking data, to actually be fact checked. This is important. When we're peers, we have to be able to fact check each other. You can't just sit on stage and throw out some numbers and think that that's not, oh, that's the gospel. It's not the gospel. So when you see the younger generation, they're gonna timestamp it. They're gonna chapterize it, because they're gonna put it into a chapter. They're gonna say, okay, well, at these few moments you said this statement, and we're gonna go on the internet, see if that's actual true, and then we're gonna timestamp it with the real information. So when somebody else is watching it, it's gonna pop up and it's gonna say, guess what? This information is not accurate. These people are being sourced in the incorrect. They're sourcing information in an incorrect way, and this is the source that they even quoted and how they misquoted it, or how that source wasn't credible, or things of that nature. So eh, the older generation has the benefit of being able to utilize language in a very crass way. They're able to speak about things, and it's just pure sales and pure marketing. Well, guess what? Now that they have the internet around the younger generation, they can clearly be able to source your bullshit very, very quickly. They can literally say, guess what? That's not true. Why? Because they literally just Googled it. They just sourced it. They duck duck goaded on the black market. They understand these different platforms. Whether they're meta trends or not, they're able to source these different platforms. They're not. It's what's interesting is they might be less biased than the olders. Where the olders are saying, "Oh, we're not going to engage in these platforms. We're not going to just take the technology and develop it overnight." The youngers are going to say, "You know what? We're going to develop the technology. We're going to know everything about you that the olders wanted to hide. So we're going to create a surveillance company." You think younger people are not creating surveillance companies? We're going to create a technology company that we can have a camera that sees everything. They're more Orwellian than the older generation. They're okay with cameras being on them. Why? Because they don't want you to be able to hide anything from them. They see who Mark Zuckerberg is, and they really don't trust him as the owner of Facebook. So they actually don't appreciate technology and what would be considered the benefit of it. So we're going to use the technology now to make sure no one abuses it. You hear how that sounds? This equality mentality. We want surveillance on everybody. You think that's going to ever happen? No. So what they're going to end up doing is creating an Orwellian society where, because they think like that, they're the next generation of politicians. They're going to go in and they're going to create Orwellian thought process in the society, which is, once again, we're going to have surveillance on everybody. Why? Because we don't want anybody to be able to hide anything. That's your next group and regime of leadership, ladies and gentlemen. If you don't go into politics as a millennial, as an older, if you don't go in and create the legislation that's going to stop that for right now, guess what? The youngers are going to go in there and create technology to say, well, we think a lot of people that are rich anyways are hiding things, so let's find out. We can pass legislation to do what? See if we can surveil them. What do you think people in the private are doing right now? Just privatizing their wealth even more. You think that's them putting it on the metaverse? You think that's them putting their money in a position where it can be so-called the online crypto ledger, where everybody in the world can see the crypto ledger? Do you really think that? Listen to what we just said. The so-called crypto ledger is able to track the transactions, right? Right. And it's on the internet, right? Right. Why would private wealth put their money on that type of platform? But it's supposedly going to be the revolution to money. Because everybody needs to have their money tracked? Right. Because we need to know where all the money's going. Who's we? The younger generation. We see this wealth gap. We see meritocracy at work. We see that. We have an entitlement mentality, supposedly. Since our parents didn't leave us with 401ks, pensions, and IRAs, we now have to be a lot more aggressive in doing what? Creating entitlement programs. One of those programs is making sure that businesses are surveilled through an accounting system, online, through the internet. That's tracked and encrypted. That's not allowing people to just hide things on paper in the books like they do in other countries. So we're gonna what? You gonna make people you are you gonna force businesses to do transactions in Bitcoin? Are you gonna force businesses to do contracts, do business through these crypto coins? That's what you're gonna force businesses to do, so you can make sure that they're tracking their transactions overseas and back to the states. They said, oh, these companies aren't paying taxes. They're not paying taxes. The big Fortune 500s, they're not paying taxes. Oh, these people aren't paying taxes. They're high net worth investors. They're not paying taxes. Okay. So you think they're going to, who's going to make them? Who's going to make them? The politicians, right? Right. Okay. So the politicians say, let's pass legislation for these companies now to track their transactions through these coins, through the government coin, through this coin, because you're using Federal Reserve notes, right? Right. Do you hear this type of thought process, ladies and gentlemen? The Orwellian thought process seeping into the culture. So when they say, "Well, if you're a Fortune 500 and you're a public company, we can't let Enron happen again. We haven't seen an Enron happen in a long time. We don't know if Tesla's the next best thing to do that because why? These companies, are they making any money? Are they paying any taxes? They're the largest companies in the United States. Can they go under? Can they get bought out? Maybe not because they're one of the largest companies in the world via market cap. That's how they made sure they didn't get bought out. Because there's a lot of companies like them right now, like these EV companies that literally they're still having high valuations. I mean, there's an EV company that sold less than, let's just say, 1,000 cars last year. Electric vehicle company that sold less than 1,000 vehicles last year, and it supposedly is worth billions of dollars. How is it worth billions of dollars? They sold less than 1,000 cars. These are the valuations in the era that we're living in. I mean, you have to be very clear on that because for an EV company to even have that level of valuation, I mean, they're saying that they're saying that they're making it. You would think that they're saying they're at least selling half of what they're worth, or their company actually has it on assets, and these companies don't. And that's the misinformation dissemination is that you start seeing it a lot of times. A lot of people they're buying into these tchotchkes, these companies, that these companies are the next best thing, that this is the next best thing, this is the next best thing, this is the next best thing. Guess what? It's always the next best thing. Oh, let me put my money in this company. We seen companies go public. They ain't even returned to their original, they haven't returned to their original valuation price yet. What a joke. But they're billion-dollar valuations, ladies and gentlemen. You have to understand these people have sold zero. Some of these EV companies have already said we're not going to sell cars this year because there's a chip shortage. We're slowing down on cars this year. We're cutting our projections because there's a chip shortage. There's a lithium shortage. There's shortages, but they're getting billion-dollar valuations. I mean, this is the era that we're living in, ladies and gentlemen. I mean, please be aware of it. It's crazy nowadays. It's just you see the thought process that's going on nowadays with these where you ask where's the capital being given? Private equity, hedge funds, institutions are giving money to these type of companies. They haven't even sold 500 cars. Think about how much more you could use that money in your business. Whether it's a local, once again, five-star restaurant from a high-end chef or something or whatever, these are the things that you could be doing, things that could be done in a society that are like, well, okay, yeah, and they're also funding car companies, these private equities, these hedge funds, these VCs. They're funding these companies to say that they're going to have electric vehicles and everybody's going to be driving these things. And next thing you know, bam, where are we at? Right now, they're not even at 60% market penetration. Be different. It was close to half. They're not even there. But they got billion-dollar valuations. I mean, it's great to see like, oh wow, you might be a $300 billion company at one point, but right now you're worth 32 billion or less than 30 billion, and it's like, well, how do you even have that valuation? You haven't even sold more than 100 million cars, 100 million dollars in cars yet. You haven't sold more than 100 million. Yeah, like 100 million. They haven't sold more than that yet, but they got billion-dollar valuations. Yeah, we're living in a, and it doesn't matter about inflation. Like, where's the money going? It's going to those guys. We're gonna talk about this Bitcoin garbage, man. We don't care. once again, we've seen investors talk about this throughout the years. Oh man, it's the Bitcoin. It's the so-called stuff. We're gonna say here. Look, why is it that and it's interesting. It's really just the marketing, ladies and gentlemen. I mean, you got to know institutions are already in there. It's just marketing because when you really see what utility this stuff has, um, one of the things that we sat at the table and we seen the first gen ultra high net worth investors say is they really focus on like finding businesses with quality operators. So when you think about you know Bitcoin, quote unquote, or those companies, are they really a business? Do they have an operator? The whole company is supposed to be around transparency, but then you don't know. They try to say it's supposed to have no rules, but it does have rules. They operate off the rule of scarcity. There are rules in life, ladies and gentlemen, but this is the thought process that they're trying to trick people into to buy into a what? A online, encrypted, trackable ledgering system so they can shake out the black money in the market. Oh, but black money, they don't, what did it say? Black money might be using it, and really, people are trying to say that that's what it's really used for is black money. Well, if it's a public ledger, that means it's not black anymore. Do you hear that? If it's a public ledger, let it be said, right? That means it's not a black market. Like, that literally means that supposedly these transactions can be tracked because it's on a public ledger. And the public authorities, whether it's via the Patriot Act or otherwise, will be able to have access to look at these records for what? For illicit reasons. That's why. So let's talk about that. Well, yeah, it's not the black market money now. It's the moving into the corporate environment now, where they're accepting it in Bitcoin and they're just filing it on their taxes as a dollar transaction because Bitcoin is valued against the dollar as a commodity, quote unquote, or as a currency, quote unquote. But guess what? It's the one currency that doesn't have a country backing it. See, they try to say, well, it doesn't have gold backing it. These cash doesn't have gold backing it. No, cash doesn't have gold backing it. Cash has the faith of the people. Whoa, what's the faith of the people for the Bitcoin? Okay, look, the currency of the dollar is tied to the country, not just the people. It's tied to the country. It's tied to many various factors within that situation. They actually have a thing called the dollar index. So we could say that, oh, the dollar's losing value, or it's maintaining value, or it's gaining value because it's a currency against other currencies. So where is this Bitcoin's value derived from? The scarcity, right? You start asking these questions and it turns into a big goddamn circle like that a cat plays with. It's a ball. Well, we're going to say this. We're not going to knock it. We're not going to say that it's not economically feasible. What we're going to say is when you hear the ultra high net worth investors say allocate a small portion of the portfolio to it, those are prudent investment thought processes towards these type of emerging technologies as opposed to overcommitting and changing the volatility in your portfolio. Because these things are, they said, oh, it's over 1,800 or 18,000 coins that have been created, and you see which ones are the major players. So we see a lot of volatility in the market. We see a lot of change of guard, even though you really only see like the top three people. They've been the same top three people for a while now, since maybe the beginning of it. But the top three people are the top three people. The rest of them are in constant rotation. So we're seeing a change in guard. We're seeing, people want to see this online ledgering system be down in the public and moving forward. And then you see people that are like, look, as long as we have gap principles, which not every country utilizes gap principles, then at the end of the day, what are you going to do? And we see a younger progressive mindset towards more technology based instead of it actually being about accountability. It doesn't look like it's accountability. It looks like it's more about surveillance. It's what the older people used to call. They called it Big Brother. There's just more Big Brother thought process. It's core Orwellian thought process. It's been coming into the society more and more, whether it's online transactions or otherwise. This lack of privacy. So now we're in the age of so-called no privacy, but that's not true, and you have to be able to distinguish yourself in this environment. And what's so interesting is even at the high net worth investor environment, we rarely saw cameras be able to be used, and that's the wild part, is that you don't see people using cameras and stuff. And that's interesting because it's tough to see that, ladies and gentlemen. It really is, because the public market is so focused on public pictures and stuff of that nature. And it's just unfortunate now that we are in this marketplace of pure open surveillance or open security, and that's what they're going to call it, open security. Oh, there's always a constant data feed of surveillance, but that doesn't mean anybody's always watching it, right? But it's still constant surveillance. So seeing this type of thought process, ladies and gentlemen, we're not going to say it's the worst thing ever, but we are going to say that this is going to be something that's going to be continued, permeated, and pushed into the society. And you just kind of got to be aware of it and be okay with it. And you got to be able to navigate nowadays, especially as a private individual or a private family or a private business. You have to be able to maintain your privacy as a private family. They say, oh, why don't you get these families to make a video and come down to DC and share about the glories of what builds America, which is these businesses, these entrepreneurs and families. Well, yeah, that's true. But there's also media out here saying, well, let's go against the entrepreneurs, and let's have greater wealthy taxes and things of that nature. Yeah, right. It's about your family and building a business. That's what it's about. Appreciate everybody for tuning in live, listen, replay. Always appreciate everybody that tunes in live, listen, replay. Feel free to reach out, Christian at trustchristian.com. Once again, that's Christian at trustchristian.com. We look forward to hearing from everybody. Trustee Training, we got a lot coming this year. We will most likely going to end up getting ready to gear towards the conference at one point this year. It'll most likely be within the summer months, maybe midsummer, right before school, or right after the start. So we'll make it a point to get it going here with our trustees, because we saw a lot of great dynamics come out of that conference, and everybody's events are different, but we still want to still duplicate success, and that's a big deal. So appreciate everybody for tuning in live, listen, replay. Feel free to be ready for that workshop, and